Hello and welcome to our conversation on the financial statements. The focus of our discussion today are the financial statements of Waaree Engine Energies Limited, which is coming to the market, and the IPO is open from 21st October to 23rd October. We are going to see the financial statements pre-IPO and understand what are these financial statements saying about this company. As in the past, we will not get into the non-financial aspects of the business. We will try to understand the company only through the financial statements. So Waaree Energies Limited was incorporated on December 18, 1990, and it was called Anmol Fluid Connectors Private Limited. And it's headquartered in Mumbai. But then the name got changed and called Waaree Solar Private Limited in 2007. Then it became Waaree Energies Private Limited in 2007 December, and finally become a public limited company in 2013, and the name was Waaree Energies Limited. And Waaree has India's largest aggregate installed capacity of 12 gigawatts of solar energy. Waaree's plants mostly located in Gujarat. Out of these 5 plants, 4, Chikli, Surat, Nandigram, Tum are in Gujarat, and Noida is in UP. One of these subsidiaries of Waaree Energies Limited, where Waaree Energies has 74.5% stake, the Waaree Renewable Technologies Limited, had already gone to the market way back in 2012. The issue price was 22 and the current price is 1755. In fact, it has given huge returns to the shareholders particularly during the last few years. Let us observe the price of this company and see the returns that the technology company has given. So in the last 5 years, if you put in November, the price was around 2.36, way below the IPO price. But in the last 5 years, the price touched the maximum of 2,748. And at present, it is trading at 1654. So one of the companies of this parent company, Waaree Energies, has already demonstrated its ability to generate returns for the shareholder. So the question is whether the parent company will also repeat the history and do what its subsidiary has delivered. Only time will tell. Now let us see the financial statements. For this, we have used 2 sources. One is the screener. The other one is the red herring prospectus submitted with the SEBI. So we can see the balance sheet of the company, and we have taken the consolidated balance sheet. The equity capital has increased from 197 crore to 263 crore. But more important is to observe the reserves. The reserves have gone up from 101 crore to 3,825 crores. And a significant part of it is actually the profits. And some part of it is also the issue of shares at a premium, which has happened in the last few years. At the same time, we can also see the fixed assets have gone up from 152 to 1,450. And keep a watch on, observe the capital work in progress too. We'll get into that details. We can see that the equity of the company has increased over a period of time from 298 crores to 4,088 crore. Equity is capital plus reserves. And what did the company do with this? The profit generated or the money raised at a premium, they've used that money to create the fixed assets. Fixed assets plus the capital work in progress has during this period has increased from 192 crores to 2,791 crore. And it's important to understand there is a significant part of this composition is CWIP. CWIP is a capital work in progress. And the capital work in progress is also relevant to the business. The solar PV module capacity, which is in gigawatts, existing 13.3. The proposed domestic is another 6 gigawatts, which will be funded by the new public issue. And in United States, 1.6 gigawatts. Solar cell capacity, okay, which is at present they don't have. They want to get into that. And it's 5.4 gigawatt. And the domestic is 6. The total is 11.4. So this gives us an idea that the entire value chain of the production of PV rooftop panels, every component this company is trying to capture. But at the same time, we should also not ignore something which is not visible on the financial statement, particularly at the time of IPO. It is always important to observe what is not there on the balance sheet also. And one such item is a contingent liabilities. Contingent liability, as the name itself shows, will become liability on the happening or not happening of some events. So therefore, they are off-balance sheet items. And from the RHP, the red herring prospectus, we saw that the contingent liabilities has increased from 600 crores to 1,517 crores in the last 3 years, 2022 to 2024. However, it is also not advisable to see contingent liability as a standalone number. It should be related to link it with the equity or the total assets. And because the equity and total assets of the companies is rising, the contingent liability as a percentage of equity has come down from 142% to 37%. Similarly, the contingent liability as a percentage of assets have gone down from 28 to 13%. You may ask, what is the relevance of this? Particularly when companies are going for IPO, if there is a significant amount of contingent liability as a percentage of equity or as a percentage of total asset, then it is a matter of worry, because there is a possibility that the company may get into trouble if these contingent liability becomes actual liability. So in case of Waaree Energies, though the absolute amount of contingent liabilities have gone up, but relatively contingent liability as a percentage of equity and as a percentage of total assets has gone down. Now let us see profit and loss account, income statement. Here also we have taken the consolidated financial statements or income statement from Screener. The sales have increased by 4.5 times, more than 4.5 times. Okay, so from 1,996 crore to 11,398 crore. We'll understand what are those sales as we move along. But during this period of 5 years, the net profit has increased by 31 times. So the increase in profit, the rate of increase in profit is much higher than the rate of increase in sales to a large extent because of the management of expenses. Because the sales have increased, profit have increased, obviously profit as a percentage of sales, that is PAT by sales, which we normally called as return on sales, has increased from 2% to 11% in the last 5 years. So is the case with the return on equity. Return on equity is a PAT by equity. Return on sales is a PAT by sales. Return on equity has gone up from 13% to 31% during this period. So not only the sales have increased or profit in absolute terms have increased, but profitability as a percentage of sales and profit as a percentage of equity has also improved. This definitely talks positive, sends positive signals about the operations, financial performance of the company. This is the case with the industry also. The industry itself is a sunrise industry. Sales, we can see, we can pick up one item, some of the important items of the income statement and understand a bit more about that particular item. The sales. Sales have gone up from 1,900 to 11,000 crore. And a significant part of sales, about 55%, is a direct sales. Exports account for 24%, and sales to franchisees about 21%. What is the sales consists of? The sales consists of the sale of solar power products, sale of services, EPC projects, and some small percentage of generation of electricity from the renewable sources. And also there are other operating revenues like sale of scrap, franchisee fees, and project management fees. But out of 34,000 crore is a large chunk of the sales is from the sale of solar power products, because that's their mainstream product. Though this fall under the regulated industry like power sector, the pricing of these products are not regulated. The pricing is to a large extent market driven as of now. So therefore, pricing, this revenue depends on the pricing strategies of this company. The pricing of this product depends on variety of factors, including market demand, raw material costs, and their transportation costs, inventory management, competitors' price, and as well as also the pressure of the customers. Because they sell both domestic and international, the prices for different ranges are also affected by local regulations and the tax policies. So therefore, it's a management decision to fix price. And to a large extent, managing price here is managing cost also. But there is something to worry about in the sales. The sales has gone up, of course. However, the prospectus says that top 10 customers account for 56% of the total revenue. Top 10 customers. Top 5 customers account for 40% of the revenue. So therefore, to a large extent, the sales is dictated by this large and small number of customers. So, so the top line of the company depends on a very small number of customers. So if there any shift happens on these customers, there will be a problem on the income statement, on sales, as well as the bottom line, top line, as well as the bottom line. Later on, also we'll see this is one of the risks of the firm. The sales going up, price is within your, it's your decision, the company's decision, but the composition of the sales on the base of customers is something to be worried about. Moreover, there is a significant amount of foreign currency exposure, both on the sales side as well as on the expenses side. So we have seen that the sales are going up. Similarly, the expenses has also gone up from 1,900 crores to 9,000 crore. But because a significant part of the expense is material, a large portion of this expense is denominated in a foreign currency. For example, in 2024, 75% of the total expenses are exposed to the foreign currency fluctuations. But what is this? Which expenses? So, sorry. So the expenses that we have seen here, 9,823 crore or 5,900 crores and so on and so forth. In the last 5 years, more than 75% of the total expenses are the material cost. The other overheads like manufacturing expenses, employee cost, and other costs account for the balance. So managing the expenses of this company is managing the material cost. In order to remain competitive, the company's cost and expenses play a very important role. How to source the material, maintain some stable and sufficient supply of material. And the major material sources they include the solar cells. They don't manufacture glass and aluminum panels. So this account for a significant part of the total cost. And company sources this raw material from number of international as well as local vendors. The changes in the import duties and also the relevant laws in the respective countries therefore affect the cost of the material. So they will be very volatile. So it is not fully, if this foreign currency exposure is not properly managed, either to be shifting to the market, to the customer, or hedging through other risk management techniques, the company is definitely exposed to this currency risk fluctuation. This is important to be noted because the material costs account for a significant part of the total cost. And within this material, okay, you can see that a big amount of imported material is in 2021 about 21,000 crores, 2,100 crore. In 2023, 6,900 crore, and 2024, 7,000 crore. A big percentage is the imported cost of the imported material. So 70% of the total expense is material and 90% of the material is imported. Let us see the employee cost. Employee cost has gone up from 569 million to 1771 million. So though percentage-wise is not a very big chunk of the total cost, but it is always good to understand the employee cost to retain people. So it's not a very big percentage of the total cost. Other costs is the rest of the overheads fall under that: rent, insurance, business promotion, commissions, um, depreciations, repairs and maintenance all fall under the selling distribution overheads. We can club them together. So for this company and the companies which fall in this industry, managing profit to a large extent is managing price and managing the cost of the material. Now let us see the cash flows of the company. Cash flows is very positive signals are visible in the cash flow statement. All through the company has been generating positive CFO. Profit is positive and cash from operating activity is also positive. That means the company is not only able to generate cash from, is not only able to generate profit, but is also able to convert the profit into cash. And what are they doing with that cash? They're using that cash to create assets, which is also visible in the cash from investment is a negative. Consistent negative CFI with a consistent positive CFO is a sign of a growth company, is a sign of a growing company. The company is growing because the assets are growing. And where is that fund coming from? The business is generating cash to finance the acquisition of assets. And there is no much cash from negative CFI. Let us observe the cash flows of this company. The cash flows of this company, particularly the negative, particularly the CFI, CFF, cash from financing, we can see that the company has not paid any dividend, no dividend. So whatever outflow is having because of some repayments of the borrowings and some amount of fresh issue of shares have been made, not to the public, but a private placement. So it's important and interesting to observe that despite the fact that the company is making profit, the company has not declared dividend. So no negative CFF. So positive CFO, positive cash from operations, negative CFF, PFI, that is negative cash from investment, is an indication that the company is growing and growing with its own funds. So if you observe the competitors, so this company is way ahead of its competitors. No, there is no listed company directly exactly in the same business. It's very difficult to find. But the prospectus has mentioned about two companies, Websol Energies and Premier Energies. The income of this company is about 11 million, so 1,16,000 million, which is 3.5 times of Premier agencies. The earning per share is 48, whereas the earning per share for Websol Energy is negative, and earning per share for Premier is 6.9, the basic earning. The return on net worth is competitive, is comparable with the Premier Energies. The book value per share, net asset value per share, is 154. That means asset backup per share um, for this company is 154 rupees per share, whereas the Premier Energies is only 14 rupees per share. So the fundamentals of the company in comparison to their own uh, the other players operating in that industry seems to be much better, and the company has been doing quite well, and one of its subsidiaries has already demonstrated its ability to create wealth for the shareholder, and plus this company is in a sunrise industry. Now let us see the offer. The company is making an IPO, and the face value of the share is 10. And through book building exercise, the upper price band is 1503, and the lowest price is 101,427. If we use the upper price band, the market cap post IPO would be 43,000 crores. If we use the lowest price band, the market cap will be 40,000 crore. And the entire IPO is not a fresh issue. It consists of two parts. One is a offer for sale. The other is a fresh issue. Up to 4.8 lakh, 48 lakh, 4.8 million equity shares is a OFS. One of the promoter companies is going to divest 4.8 million shares. The first issue is 23 million equity shares. So 3,600 crore by using the highest price of the highest band. So 3,600 crore the company will receive. 721 crore the promoters will receive. So this is the money post-issue will come to the company's balance sheet. Capital will go up and cash will go up to that extent. Whereas for the OFS, 721 is the money that will go to the divesting shareholder. And what will they do with that money? That is 3,600 crore. According to the prospectus, they're going to use that to set up 6 gigawatt plant by creating a manufacturing facility in Odisha, in the state of Odisha. And the balance small amount is going to be used for the normal managerial working capital or corporate purposes. So around 2,700 crore has been identified as to be used for creation of further capacity. Will be allocated to establish a 6 gigawatt manufacturing facility for ingots, wafers, solar cells, and PV modules in Odisha. And this facility will be developed through Waaree's wholly owned subsidiary, Sangam Solar One Private Limited. So this is quite a big project at the country level as well as for the state of Odisha. And first time this company is coming out of Gujarat and the northern or western part and coming to the eastern part of the country. There are, despite the fact that financials are conveying a positive message, the rising profit, rising sales, rising equity, comparable P ratio, EPS, and return on equity, return on net worth, manageable contingent liabilities, big amount of inflow of capital post-IPO into the company, and no dividend, much distribution, more and more plowed back. But the company has some explicit risks also facing. And the risks are visible and mentioned in the on the prospectus. Let us just have a look at some of the important risks given by the in the prospectus. One is a dependence on the key customers. As we already mentioned, a significant part of the revenue is coming from a small number of less than 10 customers. So managing customers, dependence on a small number of customers is definitely a big risk. Similarly, the customer's agreements includes a payment of liquidated damages. So that means there is a possibility of this type of a contingent liability. So this may affect the bottom line and the cash flows of the company. And since there is a big amount of foreign currency exposure, both the sales and the purchase, and particularly expenses in the form of raw material acquisition, is subject to the risks and uncertainty of various international markets. Okay. The fourth risk, as mentioned in the prospectus, that they're planning to use a big amount of this money in the capital expenditure for the part of Orissa. And this depends on various schemes and the benefits extended by the governments, both at the central government and at the state government. So there is every possibility, because there's a dependence on the government. So unanticipated delays may lead to high cost of the projects. So these are some of the explicit risks that the company has mentioned in the prospectus. So now the question I would like to end the way we ended the presentation of the other companies. The fundamental seems to be strong. The company is having risks explicitly mentioned. Now, would you like to invest in IPO, or would you like to wait and watch and then participate? Is your call. Thank you very much.